and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Oil prices are down today as U.S. President Donald Trump says a deal to end the war in Iran could be reached in 2 or 3 days. He says the Strait of Hormuz would reopen immediately after. This comes after Iran and Israel traded strikes over the weekend for the first time since April. Trump says the ongoing blockade of Iranian ports will not be lifted, though, until a final deal is reached. Canada's trade surplus widened in April as oil drove exports to a record high. It's the second consecutive trade surplus and the largest since January of 25. Meanwhile, Canada's trade balance with the U.S. is the highest since February, when U.S. President Donald Trump introduced tariffs. The rising price of oil drove the growth, but it was offset by a 25% decline in gold, silver, and platinum. WestJet is strongly opposed to the federal government's loan offer to help airlines hit by high jet fuel costs. The company says it doesn't take government loans and advocates for a competitive environment instead. It also says Canada should stay away from distorting markets here and in the U.S. Ottawa plans to lend as much as $150 million to blunt the impact of high fuel prices caused by the closure of the Strait of Hormuz. And a quick look at the markets right now. You can see they've taken a bit of a turn, but they're holding on right now. They're still down, though, for the TSX, off by about 0.12%. And a lot of this, there's been a rotation out of richly priced technology names and more economically sensitive sectors. That's kind of flared back up. You'll see a similar situation south of the border. Take a look at this. And the S&P 500 up by 0.3. NASDAQ down by 0.8. They were well into the green to start the morning, but have since taken a turn. We'll see what happens as the day progresses. Well, OpenAI just filed for its initial public offering, joining a recent slate of massive IPOs estimated to be worth some $3.6 trillion US. Now, that includes rivals like SpaceX and Anthropic. Here to discuss that and more is Michael Monahan, portfolio manager and Founders 100 ETF. Michael, thanks as always for joining us.
Great to be here. Thanks for having us.
Okay, it's if you like IPOs, this is the year for you, isn't it?
It certainly is. We've got, SpaceX coming this week, and as you mentioned, OpenAI and Anthropic have both filed as well.
Let's talk about OpenAI, because that's the one. I mean, we know SpaceX is coming up, but OpenAI just kind of filed their papers, and they've said that we're not sure when we're going to do the IPO because some things we can get done as a private company. How do you interpret all that?
Look, I think that, yes, the timing is uncertain, but there's a lot of things that can happen in markets. So in general, once someone files, that means they'd like to come public as quickly as possible. So my guess is, they'll push this to have done in this quarter or the next quarter. I don't think we're going to be waiting very long for this at all.
So you think this it could come over the summer? They've heard talk of the fall, but you think it might be the summer?
Late summer, early fall, I think are both good target dates.
And what makes you think that?
Just, once you've hired the bankers, put the IPO into motion, the markets are holding up right now. There would be no reason to take any risk of waiting any longer. So from a risk mitigation perspective from the company and capturing the excitement and the momentum within the AI space, it makes sense to move as quickly as possible. That's how IPOs work. Once you file, you try to take them public as quickly as possible.
And with the valuation, I just saw a note that said they're giving it about a 50-50 chance that it could be $1.5 trillion or more for OpenAI. Does that sound a little on the extreme side for you, or is that realistic?
So that jives with how they're currently pricing and trading in the private markets. And so these growth curves that we're seeing within the AI space are really unprecedented. And so it's hard to value these companies looking at the past. If we think about SpaceX, for example, which is coming on Friday, they filed with $18 billion in trailing revenue. And during the roadshow, they added another $27 billion in revenue. I don't think we've ever seen a company add that much revenue in the middle of the roadshow. So I think that to value these companies, we're going to have to understand what not only was the historical revenue they were doing, but what is the run rate they're doing at the point of impact.
All right, of course, the one that is closest and everybody's attention is kind of turning to in many ways, SpaceX. Do you think you'll see that the 1.75 that or 1.75, $1.8 trillion valuation?
Yeah, so we think very high probability that it's going to come at 1.75 trillion. Remember, they set the share price in the prospectus at $135 a share. Often in a prospectus, you'll see a range of share prices. I think Elon and the bankers are signaling to the market that it's coming at 1.75 trillion. They're not going to raise it. We think there's plenty of institutional demand there. We think the stock will trade well. If I had to guess, my guess is it's 2.25 trillion on the first trade. We'd like to buy a little, so I hope it hangs out there for a little bit so we've got a chance to buy some. And my guess is it grinds higher over the next 15 trading days after the IPO. All
right, and then the third one, it feels a little lost right now. I guess all the hype is going with SpaceX and OpenAI, Anthropic. Where do you see? Is it getting lost a little bit right now?
We don't think it's getting lost at all. If anything, we see them as the premium provider within the foundational models. I would almost suggest that OpenAI right now is in what I call the Starbucks position. They're getting hit from Gemini on the low end, which is bundled for free in search, and Anthropic is taking share on the high end. And so OpenAI is going to have to figure out who they want to be in life because they've got very tough competition. Again, the Starbucks analogy, you got Dunkin' and McDonald's on the low end, and Anthropic is your local neighborhood coffee shop making the best coffee. And so we think not only is Anthropic not being lost, we think right now it has the spotlight shining on it.
All right, if you could only pick one of the three to buy, which one would you take?
Well, we own all founder-led companies, as you know from our mandate. We're going to buy SpaceX on Friday. So I think the only one that's coming, we're going to go ahead and buy.
All right. And if you could only buy two, which one wouldn't you buy of the other two?
Right now, I think Anthropic has built the best product as far as how they interact with customers, how their models are working. So Anthropic would be our next purchase.
All right. And going out from there, we heard the president saying today that there's a deal imminent. If there is a deal, where does oil go? What kind of an impact do you see that having on the markets? And will it affect these IPOs at all?
We think a deal is important. Remember, Exxon said a couple weeks ago at the Sanford Bernstein's conference that the Western world has used their supplies. We've emptied our strategic reserves, so we have to get a deal. Obviously, oil will come back down to the pre-Middle East instability position. And we think it is important for the market. You know, the market has looked through higher oil prices and inflation. But if we were to have a structural change to oil prices, that would be negative for some of these high growth stories. I don't think that's coming. I think we're finally grinding to a deal. And I really hope for all parties involved who, frankly, I believe the parties are incented to get to a deal. So I think we will.
It does. It does feel like there's both sides are kind of running out of time for different reasons, obviously, but are running out of time. And then just the markets today. Is it just a little profit taking? Do you think?
I think it's a little profit taking. I think sometimes when people start staring at a shiny object, they forget to do the rest of the work. So we had, last week, people got a little spooked by the jobs numbers, but we think those are good because they're showing the strength at Main Street, and it's really Main Street that we need to keep an entire economy moving. So that was number one. And then number two, we think all eyes are on SpaceX. So everybody's just going to wait for that deal to come on Friday, and then people will put their pencils back on the paper and start figuring out what other names they want to buy as well. So I think we could have a cool, sideways next day or two. I think we're going to have a really nice print on SpaceX. My guess is that the guys at Goldman Sachs and Morgan Stanley did an incredible job putting this deal together. The book, my guess, has been scrubbed completely clean. I think we'll see really good price action, and the market will continue to grind higher following that.
All right, we'll leave it there. Michael, thank you as always for joining us.
Love being here. Great to see you again.
Cheers, Michael. Michael Monahan, portfolio manager, founders at 100 ETF. Up next, we're watching shares in Bombardier following its $78 million investment in its Singapore hub. We'll have more after the break. We're watching shares in Bombardier following its $78 million announcement that it's going to invest and expand its Singapore maintenance and service hub. The move is expected to support an anticipated increase in the number of next-generation business jets. Earlier, Bloomberg spoke with Paul Sislian, the Executive Vice President, Aircraft Sales and Bombardier Aftermarket Services, who says it will nearly double the company's Singapore service footprint.
It's all about continued growth, right? And if you think about our Asia-Pacific market, it's a very, very important market for Bombardier. But when I say continued growth, we started this journey back in 2014 with our first service center in Singapore, 80,000 square foot facility. In 2022, that grew to 250,000 square feet. The demand was so high. So we tripled the space we have. And what we're announcing today is actually this groundbreaking this afternoon is an addition of another 250,000 square feet. So basically going from 80,000 square feet to 500,000 square feet of capacity or capability within a 14-year period. And that's all about taking care of our customers. So it's not just about having space for the aircraft that are coming into the region or the growth in utilization. It's about offering a premium service to our customers. It's having a fully encompassed ecosystem of services where they can come in and have a one-stop shop, and we make it easy for them to not only buy the aircraft, but also for use them for many, many years to come.
Did you consider a brand new location? I mean, Singapore is only one of 2 services centers for Bombardier in the APAC region.
Yeah. So we actually, if you look at our APAC region, we service the region in 3 dimensions. The first one is in China. Our first service center is in Tianjin. And then in Australia, we have a service center in Melbourne. And of course, our main hub is in Singapore. If you look at it, it is one of the main economic hubs of the region. We have a lot of our customers. We have about 320 of our aircraft that are in this region, with the majority of them being in Singapore. We see a continued growth. And for us, Seletar Airport was the right solution. With the increase in utilization, we see a lot of family offices that are bringing their aircraft into Singapore. And of course, we're delivering a lot more aircraft into this region. So it was just normal that we picked the same airport we are today, Seletar Airport, and we continue to expand that footprint to serve our customers.
Paul, from the sound of it, Bombardier is actually future-proofing future growth. How much of that is being addressed by this new investment?
Well, if you look at it, Bombardier really has 3 businesses: our OEM and our manufacturing space, which is the majority of our business. And then we have 2 growth vectors that we've been very vocal about. Our aftermarket growth segment, which was, 5 years ago, $1 billion, and last year we closed at $2.3 billion, and we have plans to grow that above $3 billion and more. And then we have our defense space. When we talk about future-proof, it's all about, we deliver about 150 aircraft a year into the market. A lot of them are coming into Asia Pacific, but there's a global expansion that we've been on. Back in 2020, we had about 2 million square feet of capacity globally. 2025, we grew that to 3 million square feet of capacity, and we're looking to extend that to 4 million square feet of capacity, because it's all about taking care of our customers, and it's offering, like I said, that ecosystem of services. It's not just the maintenance or scheduled maintenance. It's unscheduled maintenance, and it's component repair and overhaul, and it's interior and it's paint, and it's providing a fully encompassed service for our customers.
You talk about global growth. How much of that is actually the Asia-Pac region? When you take a look at your order book, it stands at a record $20 billion or so. How much of that comes from the region?
So our order book, we've hit a high of backlog of $20 billion, which we're very proud of. It's the first time in our history of our company. The Asia-Pacific region accounts for 7 to 10% of that, if you look at the historical order book and in terms of the service that we provide here. And we're looking to grow that, of course. There's a lot of demand that's coming out of the region. Of course, the aircraft that are coming into Asia-Pacific are our large, market flagship Global 5500, 6500, and of course now the market leader Global 8000. So of course, we need more footprint, and we need to make sure we can quickly access that footprint to service our customers.
The question question really, Paul, where is that growth coming from? Are we talking about, high net worth individuals who want their jets and hence the services? Or are we talking about companies which also charter out their jets? Where is growth coming from?
Yeah, if you look at our market segments, they've traditionally been split fairly equally, where we have high net worth individuals, we have Fortune 500 companies, we have fleets and fractionals, and then we have retail and defense. If you look at the main three segments, they're about 30% each. So, high net worth individuals and retail about 30%, fleets and fractionals 30%, and of course the Fortune 500s 30%. So it's fairly equal, and we're seeing that that equal spread in the Asia Pacific region as well.
Talk about the perennial issues within the industry. It is about supply chain disruptions, about deliveries. We know that you've targeted about, 157 aircraft deliveries this year. Almost halfway through the year, where are you with that?
So, we're right on track for our deliveries. We had a very, very strong Q1. If you look at our delivery profile, it's always the same. We're a little more back-ended into the second half of the year. There have been supply chain issues that the industry has to deal with. I think we did something a bit different back in 2020 when most companies were actually retrenching in terms of supply chain presence. We actually did the opposite. We doubled down into the supply chain, and we invested a huge amount of, financial and human capital, not only into our tier ones, but our tier two and our tier three suppliers, to make sure we understood how we can keep them active, what we understood where the bottlenecks were, so that when the growth did come back, we would make sure that we had the sustainable supply chain. Now, of course, are there still some issues? Yes, there are certain suppliers with some issues, but we're dealing with them, I think, very, very well, and we've been very successful with it.
The question is how resilient your supply chains have been amid the Iran war. Are you seeing any disruption along the way?
I think that the supply chains have been resilient. We have seen problems along the way back in 2020, but those have been flushed behind us. We keep close to our supply chains. That's part of Bombardier's motto, is that we stay very close to our partners, whether they're our customers or our suppliers. We want to make sure that we are active with them and we keep, the bottlenecks out of the way. We keep supplying them with information in terms of our long-term forecast so that they can keep growing at the same time that we keep growing. I think that our supply chains are strong, and then we're going to have another very, very strong year.
Coming up, today's market drivers with Bloomberg's Monique Malima. Right, 3 days to go until FIFA Fever, the World Cup, hits Canada. Officials in the host cities, Toronto and Vancouver, say they are ready for kickoff. BC Place Stadium, where 7 matches will be played, underwent a number of upgrades and renovations for the game. CTV's Andrew Johnson has more.
To bring 43-year-old BC Place up to FIFA standards, provincial taxpayers have made a major investment. But one of the most noticeable changes in fan experience will be outside.
We're encouraging people to get here early. We're opening the gates 3 hours before kickoff.
That's because fans will need to contend with airport-style screenings at dozens of checkpoints, a level of security the head of the venue for FIFA says will be similar to the 2010 Winter Games. That's after already clearing checkpoints blocks away from BC Place to enter the stadium zone. At field level, crews are maintaining the multi-million-dollar Fraser Valley-grown grass pitch. UV grow lights are being used to help keep the pitch healthy, as well as tightly controlled in-ground irrigation.
Right now, the roof, we like to keep it open on non-match days. It helps the growth of the grass to get as much natural light and air circulation around the pitch. But likely on match days, it will be closed just to create that consistent environment, in particular for broadcast television.
The stadium's upgrades extend beyond the field. Nearly $200 million in renovations include a new video board, hospitality areas, and locker rooms.
This will be Canada's dressing room for their first match here in Vancouver.
And despite hotel and ticket prices well out of reach for most, the stadium is expected to be near capacity from start to finish.
We're very close to being sold out across all 7 match days here.
More than 50,000 fans are expected to fill these seats Saturday in front of a worldwide audience of 130 million when Turkey takes on Australia. Andrew Johnson, CTV News, Vancouver.
Time to take a look at today's market movers, and for that, we're joined by Bloomberg Equities reporter Monique Malima. Monique, thanks as always for joining us. Let's get right to it. First up, fuel cell energy. It's rising on a power pipeline.
Yes. So fuel cell, their shares are surging this morning after they reported last night that their pipeline for their power projects, it rose over 200% quarter over quarter. So analysts are really positive on this growth. The company also expanded its expected facility in Connecticut. They were originally planning to have 350 megawatts of power there, and it's now going to have up to 500 megawatts. And this is really good news for the company because they need about 100 megawatts to be profitable on an earnings basis. So this will take them well past what they need and what investors had really been looking for. So the analysts on this are really positive, saying that this shows that there is clear demand, that there is going to be a lot of growth for this company ahead due to the hyperscalers and data centers that really need all of this power. They just know that the one thing is they want to see this turn into actual contracts. Right now, it's just agreements that are more loose in place. So they want to see firm contracts in place for once the company does get that power up and running, that they will be able to capitalize on this.
All right. What's going on with lithium stocks right now? Hello? Monique, you got us?
Oh, yes, I can hear you now.
Oh, okay. Lithium stocks we're asking about.
Yes. So the lithium stocks, they are rising this morning as Citi says that they are bullish on the metal. Lithium had a pullback recently, but they say that they think it's now reached a bottom. They think that there's going to be a lot of growth ahead in terms of demand. And this comes even as supply for lithium is expected to grow in Zimbabwe, Australia, and China. There's still, even with all of those new additions, going to be tight supply for this year. And they expect the stocks are also going to benefit from changes in China. China currently offers rebates for exports of fuel cell batteries, which use a lot of lithium, but those rebates are ending in 2027. So they think there's going to be a big push of companies trying to stockpile ahead of these changes. And I think that some of these stocks are going to benefit from that. So that's why we're seeing stocks like Albemarle and Sigma Lithium all trading higher this morning.
All right. And Applied Digital, there's mystery surrounding it right now.
Yes. So Applied Digital, they're trading higher this morning after they announced that they signed a 15-year lease with a U.S. AI hyperscaler. They did not name what the company was, but they said it's a major player in this space. It's for about 210 megawatts of power and has a base contract revenue of over $5 billion. So this is quite a large contract for the company, which is why we're seeing the shares trade so much higher. Analysts are really positive. They say this shows that the large players in the tech space are looking to this company for their power needs, and that this could mean that they're going to be able to get more contracts going forward. And this also just plays off again on that growing demand that they're expected to see from all the power that AI data centers are going to need. And with this large boost in revenue, this could also provide more upside for shares ahead.
Okay, awesome. Monique, thank you very much for that. Bloomberg's Monique Malima. Up next, we take a look at how AI automation could impact Canada's labor market and unemployment amid recession risks. Shares in Cineplex are trading higher today after receiving its biggest May box office since 2019. The movie theater chain earned more than $60 million in credits a diverse film slate that drove audience engagement, especially among younger moviegoers. The movies included Devil Wears Prada 2 and Michael. Cineplex says Michael is the highest grossing music biopic of all time, surpassing $300 million at the box office. Bombardier is investing $78 million to expand its Singapore maintenance and service hub. It's to support an anticipated increase in the number of business jets flying in there. The private plane maker says that there is a record backlog of orders, $20 billion plus. A tenth of that is for the Asia Pacific region. Construction will begin in the second half of the year, and the full operation should get going in 2028. Apple is expanding tools for parents to protect children online. The move comes as Canada is reportedly set to unveil a social media ban tomorrow for those under 16. Starting in the fall, Apple's features will let Parents control when kids can use apps, what content they can access, and with whom they can communicate. Tech giants are under pressure to limit children's exposure to social media, which some psychologists link to mental health risks. Okay, my next guest believes AI adoption could gravely influence workflows and positions, further risking jobs that might be lost in a downturn and potentially cause long-term unemployment. Let's hear more now from Ranella Billy Ochieng, senior economist at TD Bank. Ranella, thank you very much for joining us.
Thanks for having me.
I mean, we're starting to see AI come into play, automation come into play. Is this a double knockdown, those two together?
Well, the thing that we called out in the report is that we first have to take an assessment of Canada's labor market. So the institutional framework of our labor market makes us more predisposed to slower labor market adjustments. And what that means is that in times of downturn, we typically see smaller increases in the unemployment rate, which is a good thing, but our recovery is slower. So when you take that story and you introduce AI technology, we made it really clear in our report. By itself, AI adoption is actually a good thing. But something to keep an eye on is how that adoption manifests in a recession environment.
And are we starting to see how that adoption? I mean, we're not. There's the argument: are we technically in a recession right now? Are we not? It depends. But how are we seeing adoption take place now?
So adoption in Canada is actually moving at a slow pace. In fact, the government, when they rolled out their strategy, that's actually one of the things they talked about, that we're seeing a weaker pace of adoption. And weak adoption basically means that we're limiting ourselves from a productivity lens. So we need to see more businesses, particularly smaller businesses, lean into the moment. The way we've telegraphed the situation that we're in right now, you could think of your job as a series of tasks. And if we deconstruct our jobs and we look at the extent to which AI touches different parts of our jobs, it's an exciting time. We know that roughly over 60% of tasks that we perform can be assisted by AI. But I think what a lot of people don't focus on is the need for human judgment. And I think we can't have a conversation around AI adoption, AI benefits, without talking about the human partnership that's needed to take this opportunity to the next level. At the same time, there are also risks that would show up in an environment where we're seeing like recession, like layoffs, interacting with workflow design changes.
That sounds so Canadian, doesn't it? They're slow to adopt things, being cautious, and then wanting to protect people and try and keep jobs. I don't think we can avoid it, though, can we? I mean, AI is coming in, and in many ways, it looks like it will improve workflow. But are there areas that you're starting to see that are going to be hit hard by it?
So AI is common, and I think that's a good thing. It's an opportunity for not just some Canadians, but all Canadians. And I think the way we would like people to focus on the opportunity is to look at ways in which it's interacting with the work you do. Not just the work you're doing now, but the work you're likely to do in the future. Like, studies have shown that about 80% of the growth in the college wage gap actually can be attributed to things like automation and technology. So technology has payoff that can benefit Canadians. So Statistics Canada did a research, and they did an assessment of the roles that are the extent to which our occupations and roles are exposed to AI. And they think something in the ballpark of 60% of jobs have exposure to AI. Now, exposure doesn't mean that 60% of jobs are going to be lost to AI. That's a very inaccurate assessment. What that means is that there's an opportunity for people, specifically within the services sector, to partner with AI to improve their workflow efficiencies, to redesign the way they do things so that they can get the most out of the technology. Because one of the things that we need here in Canada is more productivity, and having a more productive workforce is going to help all of us.
Absolutely. I think we're struggling on that role right now. Is there more the federal and provincial governments can do with this, or should they kind of just stand to the side and let the private sector deal with it?
I think governments have a role to play, as well as the private sector. The thing that we call out in the report with regards to the policy conversation is the need for policymakers to ensure that they are providing the right support to Canadians at the right time. So historically speaking, if we have a downturn and there are job losses, oftentimes when the economy recovers, a lot of the jobs that return, they look very similar to the jobs that were lost. But AI adoption has the potential to, reorient changes in the labor market that can see net new jobs created looking a lot different than the old jobs. And that's something that policymakers need to keep an eye on, because at the end of the day, it's a case where if we have workers who are displaced and displaced for a long time, we need to ensure that we are pointing these workers in the right direction. I don't think it's a case where new jobs are not being created. It's a case of what type of jobs are being created and where are we encouraging Canadians, especially displaced Canadians, to explore new opportunities. And I think that's where policymakers need to be proactive on creating not just information, but ensuring that people who need the help make use of the opportunity.
Okay, we have to wrap it up there, Ranella, but thank you very much for joining us.
Thanks for having me.
Ranella Billiot-Cheng, senior economist at TD Economics. Coming up, what are the consequences of AI's computer shortage? We'll get more on that after the break. A new report is exploring the unintended consequences of AI's compute shortage, what it's calling a butterfly effect. We'll explore what that means for the future. We were joined earlier by Bhavtosh Vajpayee, Managing Director and Head of Technology Research at CLSA Global Technology.
You look at demand divided by supply, that's 1.7 currently. It should stay at 1.3, 1.4 next year as well. So this is not a short-term problem. This is at least a 2-year problem.
And what does this mean then for AI, moving AI forward, especially with all the CapEx we've seen?
Well, AI optimists are in a joyous mood. This suggests that adoption is very strong. The growth of token demand is much faster than expected. So those are the good things. The not so good things are the rising cost of compute, which is rising very fast. Tokens grew about 20 or 30% month on month in March. We are seeing 20% increases in rental prices, not just for the latest GPUs, NVIDIA Blackwells, but also for the older ones like Hoppers. This is going to have, as we call it, unintended consequences on a number of things. So, for example, we have started hearing of the rationing of tokens, the withdrawal of AI privileges for employees, and things like that. It could also lead to worsening losses for AI startups. Over the next few months, it could lead to a slowdown in enterprise adoption. So not everything is good.
Hi, Bhavtosh. Thanks for joining us this morning. On this topic of tokens, I'm wondering if you could, for our audience at home, just simplify and explain what the token jam there is right now. Essentially, from our understanding, is that whenever you put a request into one of these LLMs, there's a certain required amount of token, almost energy usage, if you want to call it that, to generate the response. And obviously, the more complex the request, the more tokens are needed. And so would that be a fair way to characterize it, or was there anything you would add to that for our audience at home?
Sure. So this is all about uptake and adoption. We have hundreds of millions of people exploring AI for the first time. Their intensity of usage is also increasing. We all started as experimenters and explorers. We asked a few questions. We were delighted with the answers. Now the frontier explorers are creating agents of their own. And therefore, the usage of tokens, which is simply one unit of compute in the AI world, could be a word that is part of the question that you ask AI. That's exploding. And we are talking of quadrillions here, where a quadrillion is 1,000 trillion. So quadrillions per month is how it is measured. But tokens have to be processed by chips, and chips have to be produced somewhere, and most of that is produced by TSMC. Our estimation suggests that chip production is increasing. Last year, it was about 7 million chips. This year will grow to about 12 or 13 million chips. But the growth of production and the growth of compute supply, even though the new chips are faster, is well behind the growth of demand. And that's a problem that will not go away because we are dealing with a physical issue here. Semiconductor plants have to be created, machines have to be set up. It takes time. And that time in our estimation is at least the next 2 years, if not slightly more.
And I have to ask, you mentioned that Uber is playing a role in this?
Well, Uber was quoted in the media saying that their annual AI budget was exhausted by April. Apparently, their 5,000 or so engineers used so much AI that they ran out of their token budget. So that was well quoted in the media, but there have been other instances too. And frankly, if you just look at the math, we are not seeing token costs or the compute costs go down as yet because it's taking time for the latest and greatest GPUs and ASICs to be produced, to be installed. And as a result, there is increasing demand for the same infrastructure, which leaves just one variable called pricing. And pricing has started to go up. Normally in technology, everything gets cheaper. And AI compute will also get cheaper in the next few years, but not immediately.
So on that note, exactly, I think that's a great segment to ask another question on this. But so essentially, you're saying demand has risen so quickly, the supply of chips and semiconductor plants is not reaching it. So that would lead to the conclusion that should these AI companies like OpenAI or Anthropic just be significantly raising prices to figure out where that equilibrium demand is, and maybe it's for a large corporate Fortune 500 company, maybe your AI budget has to double or triple to meet that supply. And I think, are we in the early stages of that, that supply-demand balance being figured out through pricing?
Yeah, you gave two amazing solutions. I'll add a third. I think it's time for AI workloads to splinter and to go where they belong. Not every AI workload is so complex to be put on the GPT 5.5 or the Claude Opus 4.8 latest models. There are many workloads like summarization of emails, a summary of calls like this that can be put on older models, and those older models need to be cheaper, much cheaper. There are a number of open source models, especially from the Chinese LLMs that we have tested. They are almost as accurate. Some of them have higher latency. They take a few more seconds to provide the answer, but their pricing is fractional compared to the frontier LLMs in the West. So we are heading into a summer where there will be changes in how workloads are allocated to the latest and greatest models, the older models, the budget models, and the Chinese open source models. And by the time summer is over, we'll probably be in a very different scenario of which model is processing which kind of workload. And that's one way to reduce this cost inflation.
And I just want to ask, what kind of an impact does this have? We have 3 massive IPOs coming up. What kind of an impact does it have on those 3?
Well, in this case, the focus should be on the 2 big IPOs, Anthropic and OpenAI, that directly relate to AI. And if you have to interpret it positively, there's massive demand, and the growth of revenues of Anthropic has been well quoted. So that's amazing. The darker side of this is that we are headed into a period of confusion, potential slowdown in token growth because there's no oxygen in the room. The cost inflation is so high that uptake of AI kind of slows or stalls in the summer. And these are not good things ahead of big IPOs. At the same time, there could be pressure across the food chain to solve the problem, as you said. So how will the problem be solved? Maybe Anthropic and OpenAI need to cut prices at least for their older models to make sure that they don't lose market share to open source models from China. And how will that cut in pricing impact the profitability that they present to investors during their IPO meetings is going to be interesting. So I think not everything is in equilibrium, and in fact, we are heading into a disturbance in the equilibrium as this crunch continues.
That was Bhavtosh Vajpayee, Managing Director and Head of Technology Research at CLSA Global Technology. Up next, on the radar, we'll see why MDA Space is on one investor's radar. That's next. Time now for On the Radar, our daily segment where financial experts and portfolio managers highlight specific stocks, industry trends, and economic themes they're currently monitoring. We're joined earlier by Bryden Teich, Chief Investment Officer at Avenue Investment Management, and kick things off with his thoughts on MDA Space.
It's one that we've owned in our growth portfolios from the beginning of the year. And I think the idea when we started looking at it is we were looking for Canadian businesses that we thought would benefit from higher levels of government spending on defense. Yeah. And I think when we read the government release last November, it was pretty clear that the targets for fiscal spending on defense were high. And then we went through our list of what were the companies that we thought could benefit or be well positioned to benefit from that spending. And MDA Space had come up. And we've known the business for a long time. This used to be McDonald Detweiler. Mm-hmm. They did an acquisition in 2017 or 2018 of a business called, I think, Digital Globe. They changed the name, went private, and then it was Republic from a couple of years ago. But again, it's benefited in this last few months with SpaceX IPO, the idea of a space economy, and what certain businesses are in that space and can benefit from this investment. I think why MDA Space I think is interesting. A lot of the space companies or the satellite companies, they're not profitable. They're growing faster than MDA is, but MDA is a existing profitable business. I think that they're going to increasingly be in a good position to win further contracts with the government. Yep. And I think that's something where, when a government sets spending targets on defense, that money will be spent. And if I was going to say any concerns that new government, it's definitely new goals and stuff. It's definitely possible that that incentive for defense spending changes. At the same time, I think. We've talked about this previously. We're being optimistic in treating the seriousness of sort of this government's fiscal plans, and if you're in a position, if the government has open bids for contracts, there's a certain level of process, professionalization, RFP requests that you have to do, and there's private companies or smaller companies that can maybe vie for contracts, but MDA Space or a Bombardier or a CAE, they have a government relations team. They know the process. They're able to be there. They know how to work their way through it and provide what the government's asking for. So we like the underlying stability of that business. I think the excitement around growth in space and digital infrastructure in space, I think, is benefiting MDA as well. They did a U.S. listing maybe 2 months ago to sort of try to increase their shareholder base because a lot of these space ETFs and whatnot are in the U.S. and so they're trying to get inclusion to that. So that's all benefiting them. I think it's an interesting way to play both space but also the government defense contract in a very forward-looking way. So all right, this one, Texas Pacific Land. Am I buying a bridge in Brooklyn? Yeah, no, this one has a... There's no Pacific this has a very interesting long history. So I really want to flag this again. This one is in our growth equity portfolio. A colleague and I went down they had an investor day maybe 3 weeks ago in Midland, Texas. How interesting is Midland? Have you been? No, I've never been. I watched Landman, so I'm totally curious. It's kind of like that. It really is, eh? Yeah, I'll reserve my comments for off air, or off the camera. But they did a really great job of highlighting their water infrastructure business. I think so. The history of Texas Pacific Land is very interesting. It was essentially the Texas Pacific Railroad in the 1850s. They ran railroad track across the country. Yep. In the 1880s, it went bankrupt. But the bondholders for the Texas Pacific Railway essentially got this land grant that was then publicly listed as a trust. So it's been on the New York Exchange since the 1800s. Oh, wow. But they owned 800,000 acres of land in Texas, and then nothing happened for 60 years or 40 years, and then all of a sudden, obviously, the Permian Basin came about. Yeah. And it's like they owned all the land. So it was an oil and gas royalty for a long time. But I think the thing that's changed in the last decade is the growth in their water business and the water infrastructure business because of how much water is produced out of the Permian, how much water has to go down the frack well. So they're in a really good land position to be able to benefit from that. And it's a really sort of unique, interesting oil and gas royalty business for those reasons.
And not worried about fights over the water? I mean, that's becoming a huge issue.
Yeah, so it is, but they're in jurisdictionally where they are is really to their advantage. They're looking at ways to sort of be able to desalinate, reuse water, even in farming potential. Like they took us through their R&D facility where they're testing out growing plants and stuff with the water. Mm-hmm. So there is that. Like there's so much water that exists underneath the ground in Texas. There's nothing
at aquifer.
There's nothing at the surface level.
No.
So, but when you produce all this 6 million barrels a day of oil in the Permian, it produces 20 million barrels of water a day. That water needs to be handled, processed, and used somewhere. So they're trying to figure out the best use case to that, and they owned all of that land space that is able to do it. So it's a really unique, interesting business, and they're very forward-looking in that water business. But that was, the recent trip down there was the reason to highlight that.
That was Bryden Teich, Chief Investment Officer at Avenue Investment Management. Market Call is up next. Today on the show, we have Barry Schwartz, President and CIO at Baskin Wealth Management. His focus, North American large cap stocks. Thanks for watching Morning Markets. We'll see you back here tomorrow.